Hi there, everyone. Welcome back for another series of trying to find out who the best elite investor is on the whole Etoro platform. So as usual, quick background about myself. My name is Iftikharuddin. You can call me Ifti. I've got a handle called Extreme Returns on the Etoro platform. Please do consider copying me. You can start with as little as $200. I'm a chartered management accountant. I passed my exams in 1995. I've worked for big corporate companies like Unilever and Mars Confectionery. I've done headhunting, recruitment consultancy. Then I set up my own estate agency for many years, ran that successfully. I've also most recently been doing peer-to-peer car hire. In fact, I'm the largest in the UK on the private basis. If you wanted to know a little bit about me, hop across to, just type in Iftiuddin My Story, and you'll see this great cartoon I put together. It's only 1.5 minutes. And if you wanted to see the BBC interview of me as well, that was a couple of years ago, you can hop across to Iftiuddin BBC interview. Do consider subscribing to my channel, please. I've got 81 subscribers, trying to get up to 1,000 by the end of the year. And I post a lot, especially during lockdown, nearly every day. So as you know, Etoro have got a popular investor program. Very simple, get copied, get paid. 4 different levels: cadet, champion, elite, and elite pro. I've covered all the elite pros and I'm covering all the elites. There's over 50 elites now. I'm still at cadet level, so I'm not trying to compare myself yet to these guys until I get promoted. As you know, you need $500,000 assets under management. You've got to put in a fair amount of your own money, $25,000. Now, my problem is when you look at the eToro site, how do you know who to copy? Do you go to editor's choice? Do you go to most copied, trending, long-term stock, long, short, multi-strategy? How on earth do you decide? And even if you do go for the most copied, eToro have got certain filters which actually exclude their very top copiers. Sorry, investors. If you put it on this basis, we've covered Kieran. He's good, but he's not the very best. So the next thing to do is perhaps you'd want to get rid of all of the filters which they put in. Then you get someone completely different. What if you got rid of this filter as well? Then you get silly numbers as well that apps don't make any sense at all. If you look at this guy, for example, nice guy, I'm sure he is, but he hasn't been on the platform very long. He actually made a 21% loss when the market went up by nearly 50% last year, the NASDAQ 100. And his 12,100% was, I think, an anomaly, and he hasn't got any copiers anyway. So how on earth do you tell who the best is? So I've come up with a system of looking at the portfolio of each investor at the top level. So I've covered all the elite pros, covering the elite. Quality, momentum, value, 3 main investing strategies. I'm also looking at other factors as well, like objective things like how often they post, what their returns are like, how diversified their portfolio is. I analyze their portfolio and give you the best possible analysis. Okay, so today we're going to be covering somebody we've covered in the past. Really nice guy. I like him a lot. His name is Matij. Let's go through his biography. So I'm just going to make this a bit bigger. He's from Slovenia. He says, hello, fellow investor. I've joined eToro in early 2019 to avoid inflation and earn some additional income. Due to low risk, I trade without leverage and rarely short. So I mostly just trade stocks and a small amount of cryptos and ETFs. For my whole life, I enjoyed and followed science and technology improvements. I studied physics. My investments are normally related to that. I began looking into politics and economics in the late 2018, and I'm following them daily ever since. What else is there? I'd like to know more about Matij the person. Anyway, okay, let's look at his stats. So we're on the 10th of February. He had a very average January. He's had a much better February. The markets did dip in January. If you look at mine, my stats, mine was going for double figures in January before the market dipped, and I'm a bit disappointed. However, only on the 10th of February, the markets haven't, the US markets haven't even opened. We're already up 10%. So we will compare Matic to other elite investors. But I'm just saying that this is very average. He had a fantastic 2020 and a very decent 2019 as well, not a full year. And he did make money, 6.5%, when the market dipped in March last year. It's got more than 5,000 copiers, although that has been going down significantly. You can't copy him at the moment. He's blocked. He has, I think, reached his limits. I think it's 10 million, if I'm not mistaken. Yearly drawdown, very good, as is the rest of it. Looking at his portfolio, he's got 30 positions. Let's look at Tattooed Chef, because I think this is a new one for him. So I use Stockopedia because it's very good. As an accountant, I love the fact that it's got an easy layout. And all of these numbers are from published accounts. And what they've done is they've put very good information in terms of ratios, whether it's return on capital employed, whether it's PE ratio, relative strength, moving averages, share prices. There's so much on there. And a lot of these stock analysis sites are very, very similar. They've just got different layouts. I just like this one. So what we look at is quality, value, and momentum. I ignore the stock rank. I don't understand how they've come up with it, and I don't think it's very good. That's just my personal opinion. But quality, value, and momentum, those are just numbers which have come from all of the published figures. And if you wanted to know more about how they calculate that, we can simply go into momentum, and it gives you, but let's have a look at this. The definition of momentum rank is available here, but generally, high momentum shares have historically outperformed the market. Trends tend to persist, so shares with trending prices and sentiment will often continue in the direction of the prevailing trend. And it tells you exactly how they've calculated it. I'm not going to go into it now, but a lot of it is an algorithm based upon moving averages, current share price, relative strength, etc. When you look at quality, the way they've done it and defined it is to say that high-ranking companies tend to enjoy higher margins, profitability, and cash flow. That's a given. These so-called good companies, because that's what you want in a good company, isn't it? Higher margins, etc., may trade at higher valuations in the market, but have still been shown to outperform lower-ranking junk. And the way they calculate it is by looking at things like return on capital employed, long-term gross profits to assets, and so on. And finally, looking at value, so the value rank has outperformed in accordance with the value anomaly, the fact that cheap stocks tend to outperform expensive stocks, while higher ranking value shares may outperform on average. In individual cases, there may be a higher risk of finding value traps and broken business models. Now, value investing is a bit controversial, but I'm not going to go into that. This is not the time and place to do that. I'm just saying this is how they calculate it, and this is what it is. So let's go over Tattoo 2, if I can say it, Tattooed Chef Inc. Now, this is Matic's biggest positions. Market cap is 1.15 billion, same as enterprise value, which means the debt and enterprise value is, as it says here, taking into account cash and debt. So that doesn't have an impact because they're both the same here. Quality is 13, value is 28, and momentum is 51. So let's see. Let's take a step back. Let's explain who they are. So Tattooed Chef, formerly Forum Merger II Corporation, is a plant food company. The company offers a portfolio of plant-based food products include ready-to-cook bowls, zucchini, spirals, rice cauliflower, and so on. Based in the United States, Paramount, I think, if I'm not mistaken, that might be California. Their website is the holding company. It doesn't tell you very much. In terms of PE ratio, astronomical, 285. You can't do it on a cash basis. I guess they're losing money, yes. Hardly made any money at all. They're meant to make 148 in 2020 and double it next year. Not quite double, but near enough. Net profit is there, only I guess because they're holding on to lots of cash. You can't really analyze this company from a financial point of view because there's nothing to analyze. So I would take all of these numbers with a pinch of salt. What we can do is look at the share price. So looking back in June, when were they listed? Around here, 10.75, so they've doubled. Matage's investment hasn't gone anywhere yet. I think it's still early days. A lot of these other companies we've actually covered. If you wouldn't mind, go across to my channel and look for Matage. I hope it comes up. Return invest, there you go. So I've analyzed it here, published at the end of last year. This is more of an update video. So what I thought I'd do is look at some of the companies which he's got. We've covered a lot of these before, but you know what? Let's just take one by random. Let's take WBA, because that's outside the normal US tech that we see so often. So Walgreen Boots Alliance, 31 billion market cap, 43 enterprise value. That means they're carrying debt. So enterprise value, just to explain it very quickly, if the enterprise value is greater than the market cap, which is what we have here, the company has net debt. Taking a step back, let's explain for those who don't know. WBA is a holding company, pharmacy-led health and well-being company. You'd think they do well in the pandemic, and we're going to check whether they have done that or not. They're based in the United States, Deerfield. I'm pretty sure I forget where Deerfield is now. This is their website. But they're a huge retailer in America, and they've got Boots in the UK as well. And they're going into wholesale as well, and now into specialty pharmacy services as well. And it's the wholesale side that's been growing quite fast. And also, they've got lots of beauty products as well. Revenue-wise, they've been growing consistently around 6% from 103, and here between 2017 and 2018, they jumped and have been going up. So in the pandemic, 139 to 136, they did well. On the net profit basis, they took a huge hit in 2020. I'd like to know why. Is it all pandemic related? And why so much? I mean, their net profit in 2019 was nearly 4 billion, and most of that's been wiped out. They're left with just over 10% of that. So 90% of their profits were wiped out. And that happened at the operating level, which really has messed up their numbers. Having said that, their net profit hasn't been increasing substantially in those years. Then it jumped, however, it did jump up between 2017 and 2018. Was that an anomaly because it went down again? So I'd like to know why it went up by 1 billion there, then went back again to its pre-2018 level. Now, on an operating basis, it's, retail doesn't give you great margins, doesn't give you great return on capital employed, although these guys are fairly decent and have been growing it. Operating cash flow per share has been increasing, and again, an anomaly in 2018. I think they sold off part of their business. Matage would know better. Free cash flow has been going up, which is good. And they're paying a dividend. They're sitting on $1.1 billion of cash. It's a reasonable company, 74, 74, 59, reasonable. We've looked at Foot Locker, we've looked at Berkshire Hathaway. Let's look at Wynn Resorts. Now, Wynn Resorts. Now, I think we have to take all of these numbers with a pinch of salt, because this company has been hit hard by the pandemic. So I'm sure you know who they are. Steve Wynn is iconic guy, and he's named his casinos and resorts after himself. Developer, owner, and operator of destination casino resorts. I think the Macau one is the largest in the world, if I'm not mistaken. But he's got a number, and it's only a few, but they're huge. And famously, in Las Vegas, he actually knocked down the old Wynn resorts and rebuilt it from scratch. Not many people would do that. And there you go. They're based in Las Vegas, headquartered there. So revenue-wise, 4 billion, jumped to 6 billion, and kept on going up. In 2019, dipped slightly. 2020 has been hit badly by the pandemic. So I'm assuming that this is a recovery play, because on the operating basis, net profit basis, although it has been going up and down, I think part of that is through investments. Let's have a look. CapEx. Yeah, look, CapEx went up hugely. So everything they are earning on the operating basis has been going, especially in the first few years, last 2015 to 2017 at least, into reinvesting in the business. So that's making free cash flow negative. It was positive the 1 year they cut their CapEx. So this is a worrying trend for me. Why have they always been burning cash? Why? And I can see why. It's because of the CapEx being so high. But I'd like to see return on that CapEx, because those return on capital numbers aren't fantastic. For me, that's a red flag. And the other thing is, why are you paying a dividend, Wynn Resorts? Look at that, $3 per share, when they're not making money on the free cash flow basis, because they're investing so heavily on the CapEx side. I don't think companies should be paying dividends if they're not cash positive. That's just my opinion. Having said that, they are sitting on a decent cash pile of 2.3 billion. How much is it made for Matic? It's made 9%, which is okay. He's got a reasonable amount left in it. He's got a number of other companies. We've covered most of them. He's got Tapestry, which has done exceptionally well for him. AMD, a lot of people are holding on to that. Bristol Myers Squibb, not many people hold that. So let's have a look at that. Now, huge pharmaceutical company, nearly 100 billion, cash positive, because look at that enterprise value. So if you remember, if EV is less the market cap, the company is net cash, which is a good sign. Quality is 57, value 32, momentum 25. P/E ratio very, very cheap at 8. If you remember that number 8, in the S&P 500, it's 21. So even if you look around the world, 8 is exceptionally cheap. I think, yeah, there you go. The Hang Seng is at 10, but everywhere else, it's a lot higher. And even in the S&P, it's 2.1. So let's look at their dividend. Oops, wrong one. There you go. So dividend-wise, they're paying 3.2%, which is in line with the industry, but very good with the market. So this is not a bad company to have. I'm guessing, and look at that, compound annual growth rate has been going up substantially. It's been growing consistently, which is good, but there's a huge jump between 2019 and 2020. I'd like to know why. Is it pandemic related? In spite of the huge increase, look at that. On the operating basis, they lost 8.6 billion, whereas they made nearly 7 billion last year. That's a 15 billion swing. I'd like to know why. Is it pandemic related? And if so, are they going to get their money back somehow in the next year? Companies generally don't give out operating profit estimates. They do give guidance on net profit. And if you look 2021 and 2022, is that right? 17 billion? Then 18 billion next year? I would question those numbers. How can that be when they were making 3.4 billion and only 1 billion in 2017? Again, questions to ask. Operating basis margin is good and it's been growing. Return on capital employed is very good. And they make cash on the operating basis. Their capex isn't burdensome like we saw with wind resorts. And they're making a decent free cash flow per share as well. And they're growing it as well at 15% at compound annual growth rate, giving a dividend, which is fantastic. Got lots of cash, 15 billion in the bank. No worries there. Based in America, New York. So this is a good company. How much has it made for him? Oh, it hasn't made anything yet. But their share price, it's a bit of a yo-yo stock. I don't like that. In pre-pandemic, they were at 60 and even much higher before that. And they've recovered to that now. But they did go down to 46. Went up to 64, went down to 55, went up to 63, went down to 58. So this is a bit of a roller coaster ride. You've got to be prepared because look, it went up from 57 all the way up to 63 very shortly within 4 or 5 days. Then went sideways and then down, up, down, up, down. And the relative strength, you can see, hasn't been fantastic, nor have the moving averages. Yeah, I mean, the financials look good, but sentiment towards this stock isn't fantastic. I think it's actually quite cheap. Obviously, at only 8 PE ratio, it must be. I'm surprised its share price is not being reflected. Maybe in time it will. Square is a company I've got as well. If you look at my portfolio, where are you? Square. There you go. Square. And we've covered this many times, so I won't go into it again. Microsoft, a lot of people have got that. PayPal recently released earnings reports, which were fantastic. And you can see it's made a lot of money for Matage. Coca-Cola Hellenic. Let's cover that very briefly. CCH. I think they're listed. Hellenic Bottle. Yeah, they're listed on the London Stock Exchange. Bottling company, 8 billion market cap. Enterprise value just under 10. Quality 83. Value 46. Momentum 23. So this is the bottler, and it's a Swiss-based company, although they're listed on the LSE. Includes established markets, Austria, Cyprus, Greece, Italy, Northern Ireland, etc. And they are all over the place, aren't they? Emerging markets, Armenia, Belarus, Bosnia, Bulgaria. This is a good company if you want a bet on emerging markets. I wonder if Coca-Cola own much of the bottling company. Let's have a look at their major shareholders. It only shows you 55%. There you go. Coca-Cola Corporation, they own 23%. And I'd like to know more about Car Test Holding because they own almost identical amount. Pension fund is that the Norwegian pension fund? Maybe mistaken. Vanguard own part of everyone, don't they? So interesting that Coca-Cola have got a substantial stake in the bottling company. PE ratio 19, which is good. Paying a decent dividend. I like that. Return on capital employed. Let's have a look at these numbers. Revenues aren't going anywhere. 6.5 in 2014, 2019, 7, only 1% compound annual growth rate. They would have been hit in 2020. Yep, you can see a value down to 6.1 billion. Net profit is there, and it's been growing reasonably fast as well. Operating margins are reasonable. Return on capital employed is fantastic. It's okay. It's been growing, which is good. Operating cash flow is good. CapEx, and this is a very capital intensive industry, remember, the bottling plants and so on. They're keeping a lid on it, pardon the pun, and making reasonable cash flow, free cash flow. Paying dividends, which I love, and the dividend cover is good as well. Cash is there. Good. I like this company. Has it made any money for Matic? 13%. It's reasonable. Okay, let's jump across to having put all of these numbers in, what we see. And I'm going to show you his the previous analysis I did for him. So last time we only dealt with 15 companies. It was 61% concentration. This time I've expanded it 20 and it goes up to 70%. His quality ratio has gone down from 77 to 69 because all of a sudden Tattooed Chef becomes his largest holding. And although the quality of Stockopedia is 14, as we said, it's very, very difficult to analyze companies from a financial perspective when they don't have much of a track record in time. The other thing that's bringing it down is Wynn Resorts, which wasn't in his top 15 last time. That is a bit more of a worry because they've been around a long time and but that again, I would take with a slight with an asterisk over it because of the pandemic. I think this is a recovery stock. People aren't allowed to go to the resort, so obviously all the metrics will suffer greatly in the short term. Value was 33, it's gone down to 29. Again, partly because of Wynn, because of Tattooed Chef. Now, what you'll see is these numbers on quality will be different to these numbers. For example, Tesla was at 65 on the 29th of December. It's gone up to 72 because their share price and their earnings report have been updated. Obviously, all of the metrics will change. They change every day. Momentum is 70, and that leaves us with a slight reduction. When we put those numbers in, let's see what happens. In fact, just before we do that, what I wanted to do is just go through what a recent addition I've done to the analysis is looking at some of the summary. So Matic has got 30 stocks or positions in his portfolio. You can see that there. He's holding just under 16% in cash, doesn't have any ETFs, doesn't have any cryptos, and doesn't have any FX either. Doesn't short the market, doesn't use leverage, it's pure stocks. In terms of his history, let's have a quick look. Over his 1 year history, which is as far as we're allowed to do, 88% of his closing trades have been profitable, which I think is very impressive. And some of them, as you can see, are over 100%. So he has had Bitcoin in the past. You can see the closing positions here. He's had other positions which he no longer has, like Zoom. In fact, it looks like he's done quite a lot of trading in Bitcoin. Maybe he thought it's just too expensive now. I mean, just the other day, 4 days ago, he cashed out of his entire Bitcoin holding. And that company we see as well, Boss, is no longer in his portfolios, nor is Slack, which is being taken over by CRM, which he does have. And you can see reasonable returns. So he's a patient guy. I like his portfolio a lot. I think it would complement a lot of other portfolios. And I think Matic should be in most people's portfolio of stocks which they hold, if you're able to copy him. That's just my thinking. So in summary, he's a stocks only guy, very diversified internationally and sector wise. So let's put his numbers in. What we see is on a return basis, let's concentrate on that. Let's make this a bit bigger. Compare his returns. Now, it wasn't a full year in 2019, and Matic himself says that he was learning. So, but he did beat Martina, who again I don't think she had a full year there. Behind Kiran, who's a very conservative, if you can look at it, 29%, Matic is way ahead on that on the average. Ahead of Liam. Now, Liam normally is a lot more, well, he's changed, you see, but 20% wasn't a great year for him. 41% for Richard. So you can see Matic is average. I mean, it's towards the higher end of average. 95%, however, is amongst the top. So he's beaten Martina, Kiran, George, Connor, behind Dufalai, who had a fantastic year last year, ahead of all of these, Libovasa, Richard, Liam, behind Stefano, ahead of Eddie Marcin, who's admittedly wasn't a full year, and it was his first year on the platform, ahead of Social Investor Guys, ahead of Stephen, behind Lena, Jian Swang, and Dean, and obviously the other Dean as well. In terms of January, it hasn't been very good. You can see a lot of people like Connor and George have been taking advantage of the crypto craze and really raking in the profits. Matic, as you can see, did have cryptos. He doesn't have them anymore. So maybe in time, we'll see whether that was a wise decision or not. Overall, he comes in at 8th in terms of the ranking, and that's not bad. He gets 3 points. Quality is 13th. And again, some of that you have to take with a pinch of salt because some of the companies he's got don't have a long track record, as we've seen. Value is 29, which is okay. It's in the middle of the top 10. And 70 in terms of momentum is just outside the top 10. Now, I also look at how often they post. Now, why I do this is simply because I think it's important. If you look at the popular investor program, go down to frequently asked questions. One of the things which they say is, how often should a popular investor post an update? And Etoro say they're expected to update their copies at least twice per month. Weekly updates are encouraged. We've seen people who don't post for months on end, which I don't think is good. If we're holding people's money, we've got responsibility to communicate. So let's look at how often Matic posts. This is a pin post. It's just keeping people informed about what's going on with his block. And here about PayPal earnings. I'm not looking at the quality, I'm just looking at the quantity, because even if you post something very simple, this is what you see, a lot of comments, and then there's an engagement, a conversation taking place. And 8 days ago. So he's posting on a very regular basis, and you can go back all the way to his very first posts. And what you'll see is a lot of posting. So I'm going to give him the full 3 points there. It's important to be diversified in sectors. That's just good fund management discipline. And he is. I'm going to give him full 3 points. He's got international companies as well. We saw the we saw companies listed in the London Stock Exchange. We saw companies. Now, is this the New York version? Yeah, this is this is the American listing. And I think I saw not just America and London listing, I saw one more as well. There you go, China. I'm going to give him the full 3 points there. Cash, good fund management says between 5 to 10%. He's got 16, so I can only give him 1 point. There's a number of studies regarding that. I've discussed this in a lot of detail before, as in terms of the number of companies as well. If you have too few, it's too highly concentrated. If you have too many, it dilutes the return. He's got about the right number. The right number is between 15 and 25. I'm going to give him 2 points for that. Where are the profits coming from? So what you want to see is your largest profits coming from your largest positions. That's just statistically good discipline. So what we see is his largest positions are not coming from his largest whole profits are not coming from his largest positions, but nearly. I mean, Tesla and Tapestry, they're just outside. So I can't give him any points for that. And what you want to see is your smallest positions, in this case, Alibaba, the Hong Kong listing, MasterCard, and First Solar. And it's not the case. His losses are coming from gold, Barrick Gold, Bristol Myers Squibb, and Salesforce. So I can't give him any points. So he'd end up at 18. So when I put all of those numbers in, this is what we get in terms of this. So Dean Fedricks is in number 1 position. He's the Tesla stroke Bitcoin guy. And he had a very aggressive attitude towards buying, having high positions in those two. And they've done well for him. Vicente is number 2 position. Miyoshi, number 3. Dean Murphy from Germany in number 4 position. Number 5, equal with Lena, is Mr. Jian Suang. Stephen drops down to number 7. Social Investor and Marcin are in 8th position. In 10th position is Eddie Butler. 11th, Stefano and Lieber Wasser. Richard Stroud is in 13th. Liam Davis is in 14th position. Matic is in 15th. Connor is in 16th. I've got that wrong, haven't I? 14th. Equal. 16th. 17th for Connor. George Thompson drops down to 18th position. Kieran to 19th. And Martino to 20th. That's what we have. Just before we go, please do consider copying my wife, who's got the handle of Asian Tigers. Her name is Adiba. She deals with developed Asia, so plus India, so Japan, China, and the Far East. And her stats are reasonable, 7% there. She's got 20 copiers, which is not bad, very low drawdowns. And some of her portfolio has been doing really well. Those companies, this is only 2-3 months. And then there's my son, Dr. Muhammad. He's looking at green companies only. And his stats are good as well. Look at that, 7% and 6%. And he deals with companies largely that all make the world a better place. Organic foods, Tesla, and that's a medical devices company. I think Enphase is energy, as is SolarEdge, and is all in green as well. So this is me, Ifti. Thank you very much. Do consider copying. I'm trying to get to champion level. I would really appreciate whatever help I can get from all of the people listening and watching. See you guys very soon.